The bond market doesn't usually crash loudly. It breaks things quietly. Because yields don't just affect investors. They set the price of money for the entire economy. When yields rise fast, the damage doesn't show up first in headlines. It shows up in financing. Refinancing gets harder, borrowing costs jump, cash flow tightens, and suddenly a lot of business models stop working. That's why bond market stress is one of the most important silent warning signals, not because bonds are exciting, because bonds are foundational. When yields spike, three parts of the economy feel it first: housing, banks, and anyone who needs to roll debt. And that last group is bigger than people think. So what's the actual warning sign? It's not rates are high. It's when yields move in a way that changes behavior. When companies stop borrowing, when banks stop lending, when households stop buying, that's when yields break something. Let's start with the basic mechanism. A bond yield is the return lenders demand. When yields rise, it means borrowing becomes more expensive across the system. Governments feel it. Companies feel it. Households feel it. And the speed matters. A slow rise can be managed. A fast rise creates stress because contracts, budgets, and balance sheets are built on assumptions. When yields move too quickly, those assumptions fail. The first place you feel it is housing. Mortgages are long-duration borrowing. So when long-term yields rise, mortgage rates jump. That hits affordability immediately. Not eventually, immediately. Monthly payments rise. Buyer demand falls. Transaction volume slows. And housing becomes a drag even before prices adjust. That's why bond market stress often shows up in housing first. The second place you feel it is banks. Banks live in the gap between short-term funding and longer-term assets. When yields move, the value of long-duration assets moves too. If rates rose, bond prices fell, and that can create unrealized losses on bank balance sheets. Even if those losses are paper losses, they matter during stress. Because if deposits leave, banks may have to sell assets, and selling turns paper losses into real losses. So yields can weaken banks through asset values and funding pressure. The third place you feel it is refinancing. A huge part of the economy runs on rolling debt. Companies refinance bonds. Property owners refinance loans. Governments refinance deficits. When yields are low, refinancing is easy. When yields rise, refinancing becomes expensive. And when yields rise fast, refinancing can become impossible for weaker borrowers. That's when problems surface. Because many borrowers aren't failing due to operations. They're failing due to financing math. A building can be fully occupied, but if the debt resets at a much higher rate, cash flow can't support it. A company can have decent revenue, but if it needs to refinance in a tight market, it can get squeezed. So yield spikes create a refinancing wall. Now here's where the bond market becomes a warning system. Watch how markets behave during stress. In calm periods, bond auctions are routine. Demand is stable. Yields move in small increments. But when stress rises, you start seeing signs like weak auction demand, higher than expected yields, bigger price swings, and widening spreads in credit markets. This matters because it signals the system is demanding a higher price for risk. And when risk is repriced, behavior changes. Companies slow investment. Banks tighten credit. Households pull back on big purchases. So how do you know if the bond market is truly warning you versus just being noisy? You watch the second-order signals. First, credit spreads. If government yields rise but credit spreads remain stable, it's less dangerous. But if yields rise and spreads widen at the same time, that's stress. It means borrowers are being hit by higher base rates and higher risk premiums simultaneously. Second, volatility. If bond volatility spikes, it creates risk management pressure. Funds reduce exposure. Market making becomes thinner. Liquidity worsens. This is how bond volatility can spread into broader markets. Third, the currency. When yields rise sharply in one country, its currency can strengthen. That can tighten financial conditions further, especially for global borrowers with dollar exposure. Fourth, bank lending standards. If banks tighten while yields are high, it amplifies the slowdown. Now here's the most important idea. The bond market doesn't need to crash to cause damage. It only needs to raise the cost of capital enough to slow activity. That's why yields breaking something often looks like a gradual slowdown at first. Less borrowing, less lending, less construction, less hiring. Then later, it becomes visible in layoffs and defaults. So what breaks first when yields stay high or rise quickly? Usually it's the most rate-sensitive and most leveraged parts of the system. Housing affordability, commercial real estate refinancing, highly leveraged firms. and parts of the banking system exposed to long-duration assets. That's where the stress shows up earliest. And once those areas weaken, they can pull on everything else. The takeaway is simple. If you want to understand where the economy is heading, don't only watch stock headlines. Watch yields. Watch spreads. Watch refinancing conditions. Because when yields break something, it's rarely the first thing you notice, it's the first thing that changes behavior. And behavior is what drives the economy.